Hello everyone, let me introduce myself. My name is Andhika Pratama. I am from Technocrat Indonesia University, Faculty of Economics and Business, Accounting Study Program. Here I will explain what accounting means, accounting functions, accounting users, and accounting process. Enjoy watching. Understanding accounting. Accounting is the process of recording, grouping, processing and presenting financial data of a company, which can be a company, organization or individual business, in a systematic and structured manner. The information resulting from this accounting process is then used as a basis for decision-making in various financial aspects. In short, accounting can be interpreted as financial language used to describe the financial condition of a company clearly and in detail. Accounting also has several objectives, namely 1. Provide information regarding the company's accurate financial position to interested parties, such as company owners, investors, creditors, and management. This information will be very useful as a basis for making business decisions by these people. 2. Assist in making the right decisions regarding company finances. Accounting can be a tool to find out which parts of the company are deemed to need attention and improvement. That way, every interested person, such as directors or investors, can control every decision so that the business continues to run well in the long term. 3. Increasing accountability and transparency in company financial management. 4. Comply with applicable regulations and laws regarding company financial management. 5. Protect company assets from misuse. Because without good accounting, a company is very vulnerable to abuse of authority and budget. 6. As a basis for formulating corporate taxation. Accounting function. Accounting has several functions, namely 1. Recording function. Accounting functions to record all financial transactions that occur in a company chronologically and systematically. 2. Grouping function. Groups financial transactions based on their type and characteristics. 3. Processing function. Processing financial data that has been recorded and grouped to produce useful information. 4. Presentation function. Presenting financial information in the form of financial reports that are easy to understand by interested parties. 5. Supervisory function. Supervise the company's financial activities to ensure compliance with applicable laws and regulations. Types of accounting users. Users of accounting information can be divided into two groups, namely internal users and external users. Here's the explanation. Internal user. Included in the following internal user groups. 1. Director and financial manager. Directors and financial managers need accounting information to determine whether or not the company is able to pay off its debts on time to creditors, banks, suppliers. The accounting information needed can be information about the amount of cash available in the company when the loan or debt is due. 2. Operations director and marketing manager. Operations directors and marketing managers need accounting information so they can determine whether product distribution channels and marketing activities carried out by the company are effective or not. The accounting information needed can be information about the size of sales or sales trends. 3. Production managers and supervisors. Production managers and supervisors need accounting information so they can determine the cost of production, which ultimately becomes the basis for determining the product selling price per unit. The accounting information needed can be information about costs. For employees. Employees need accounting information to be able to see how the company where they work is performing. He can use this as a consideration in assessing whether or not the compensation system he is currently receiving is appropriate and is likely to be accepted in the future. External users. Categories of external users of accounting information are as follows. 1. Investors. The parties who need accounting information to determine decisions in buying, holding, and selling their share investments are investors. Investors use accounting information to make decisions about buying or disposing of their investment shares. Investors will assess whether they benefit from investment results, be it dividends, profit sharing, or capital gains. 2. Creditors. Creditors are users of debtor accounting information to evaluate the level of risk of borrowing money or providing credit. Creditors are able to minimize risk by finding out the extent of the debtor's bona fides and liquidity through the debtor's financial reports. 3. Government. The government has an interest in the financial statements of companies, taxpayers, to calculate and determine the amount of income tax that must be remitted to the state treasury. 4. Capital Market Supervisory Agency, BaPAM. BaPAM requires public corporations, issuers, to regularly attach financial reports to BaPAM. The Capital Market Supervisory Agency, BaPAM, is very interested in the financial performance of issuers with the aim of protecting investors. 5. Economists, practitioners, and analysts. Economists, practitioners, and analysts use accounting information to predict the economic situation, national income growth, determine the level of inflation, etc. Accounting process. 1. Transaction recording. The initial stage in the accounting process is recording every financial transaction that occurs within an entity. This involves collecting transaction data, such as sales, purchases, and other expenses. 2. Transaction classification. Transactions that have been recorded are then classified into appropriate categories, such as income, expenses, assets, and liabilities. This helps in understanding the nature and purpose of each transaction. 3. Corrections and adjustments. During a particular accounting period, there are adjustments made to correct errors, calculate depreciation of assets, or adjust income or expenses to reflect actual circumstances. 4. Preparation of financial reports. After all transactions have been recorded, classified, and adjusted, the next step is to prepare financial reports. This involves creating a balance sheet, income statement, and cash flow statement. 5. Interpretation and analysis. The resulting financial reports are then interpreted and analyzed to understand the entity's financial performance. This analysis helps in making strategic decisions and financial improvements. 6. Financial reporting. The financial reports that have been prepared are then presented to related parties, such as owners, management, investors, and other external parties. This allows them to understand the financial condition of the entity. 7. Audit and monitoring. As a final stage, financial reports can be audited to ensure their accuracy and reliability. This supervision is carried out to ensure compliance with applicable standards and regulations. That's a little explanation from me. Thank you for watching.